Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. And today we have a very special event here for you where we talk about the technical analysis and strategies for futures trading. And today I'm very proud to announce a new futures product that is really solely suited for retail traders. It's a smaller contract so that you can trade more efficiently with smaller account sizes. So today what I'm going to do is I'm going to do a brief introduction of futures trading, what the new contract looks like, and then what I'm going to do is I'm going to show you some technical strategies for trading these new futures contracts, whether you're looking to speculate or potentially hedge some downside risk. We saw some volatility in the markets here this week. We also saw a lot of volatility in the markets in March. So we'll talk a little bit about how you can use these futures products to potentially hedge your downside exposure on the underlying stock. Now, many of you may know me as the option strategist here at OptionsPlay, but some of you may not know is the fact that I actually started my career in derivatives trading futures. I was actually a day trader in futures for many years before I actually learned how to trade options. I actually learned how to trade options because of the fact that I was trading futures, and the platform that I was trading futures on offered a lot of options education. So that's actually how I got exposed from derivatives contracts using futures to eventually trading options. So many of you that are here today, perhaps you're options traders, perhaps you're futures traders, perhaps you're stock traders, regardless of who you are or what your background is. Today, we're going to do a quick walkthrough of futures trading, give you an understanding of the contracts, what they actually mean, how they're efficient, especially for those of you that are frequent or active traders. And then what I'm going to show you is actually my technical strategy that I use to trade futures about 12, 13 years ago when I first started trading these products. So let's go ahead and get started. But before I do, just a quick disclaimer, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. Now, we're going to do a quick introduction to futures, just for those of you that are brand new to futures and want a quick background on what futures are. We're going to talk a little bit about these new OMXS30 mini futures contracts, the different sizes they are to the full standard contracts. For those of you that may have traded them, they're really just a smaller contracts. We'll talk about the differences. I want to talk a little bit about the trading and settlement of these types of contracts, how they're a little different from trading stocks, what you can expect when you go long or short a futures contract. And then what I'll talk you through is the technical indicators that I use as a trader to gauge my directional view on the stock and how I use to generate buy and sell signals trading futures. And then what I'll do is I'll walk you through my actual strategy. I'll walk you through the strategy as well as the tips that I had in order so that you can stay disciplined when you're using these types of futures contracts for trading. And at the very end, we'll open this up for Q&A if anyone has any questions regarding these futures contracts or my technical strategy around trading these futures contracts. Now, before I get started, can everyone please bring up your chat window, which is at the bottom of your screen? And I'm curious, how many of you have experience trading futures or learned how to trade futures? Please type yes into the chat window. And if you have not traded futures before, if you're brand new to futures trading, please type no. Okay, so I see a lot of no's and a couple of yeses. Okay, so for those of you that have traded futures, the new futures contract is really no different from the standard futures. They're just smaller, they're suitable for retail. For those of you that answered no, since most of you said no, let's go through a brief introduction of what futures contracts are and give you a better understanding as to how to trade it. But predominantly what I want you to be able to walk away from the presentation here today is an understanding as to how you can utilize the new OMXS30 mini futures for your portfolio. Whether you're looking to speculate or you're looking to hedge, this is what we're here to do. So my name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay. What I'm going to share with you here today is my technical strategies around trading futures products. I have a lot of experience trading US index-based futures, which is exactly what the OMXS30 is an index-based future. And I'm going to share with you my technical strategy and my background and my rules for trading these strategies successfully, because they are, in my opinion, a great product for day trading. It requires some rules. They require a bit of discipline. So I'm going to walk you through all of those things for trading these products. So first of all, let's cover what a futures contract is. Now, before you can trade them, we must understand what we're actually trading. So just like an option contract, a futures contract is a contract between two parties. And the contract states it's really an agreement to either buy or sell a specific asset on a specific date in the future. So for option contracts, you're buying or selling a specific contract or a specific asset at a specific price in the future. When you're trading a futures contract, there's no specific price that you're necessarily buying or selling the future at. You're just simply agreeing to buy or sell that asset sometime in the future on the expiration date. Now, these contracts are all standardized, meaning when you have identical contracts, this makes it easy for any participant in the market to buy and sell and transfer the contract as long as, however you'd wish. So whether you want to buy or sell the contract, there's always going to be buyers and sellers of this standardized contract. And lastly, the futures contracts that we're referring to here today are all exchange listed. So the exchange acts as the clearinghouse. So what they're doing is they're guaranteeing the other side of this trade, so you don't have to have any concerns about any counterparty risk. If you enter a futures contract, you know that the other party on the other side is good for their money. So if you make a profit, you know you can keep that profit on that specific trade. So that's at the basis what a futures contract is. It's simply an agreement between two parties to buy or sell a specific asset sometime in the future. And they're standardized and they're cleared by the exchange, so you know that you don't have to worry about counterparty risk. So let's talk a little bit about the specific future that we're here talking about, which is the OMXS30. Now, many of you here that trade equities, how many of you are familiar at least with the OMXS30 index? Please type 1 into the chat window if you're at least familiar with the index itself. Okay, so I see a lot of 1. So most of you are familiar with it. It's like following the markets. It's a good gauge for how the markets are doing. And what the futures contract allows you to do is either buy or sell this index sometime in the future. Now, currently, they list what's called standard contracts. So the standard contract is simply the index value of the OMXS30, which earlier today was roughly around 1786. And the full futures contract is 100 multiplier of that index value, which means that one futures contract is worth 178,600 crowns, or 25 crowns per tick. Now, I'll talk a little bit about the difference between points and ticks in a little bit, because that's really for trading. So let's talk just about the size of the contract first. So if you're trading a single futures contract, you're controlling 178,000 crowns worth of the OMXS30. Now, the new mini futures contract, which recently was just launched, which you can trade at Nordnet, is the same index value multiplied by 10. It's just a smaller contract. So each contract is only 17,860 crowns per contract. So this allows you to trade much more smaller size. So if you have a smaller portfolio, maybe you don't have a 1 million crown portfolio or a 5 million crown portfolio, maybe you have a 200,000 crown portfolio. You want to trade smaller size. That's what these new future contracts were built for. It's for smaller size so that you can trade, you can have much more flexibility in choosing your contract size and choosing the appropriate size for your portfolio. And when we get to the actual strategy itself, you're going to learn why portfolio sizing and discipline around that is so important as a successful futures trader. So when we talk about futures contracts, these contracts have what we call daily cash settlement that are mark to market. So when you buy a stock, if you buy a stock at, let's say, 100 crowns, and you hold on to that stock as the stock increases day after day after day, what happens is you have an unrealized gain in your portfolio, and you keep that unrealized gain until at some point in the future you sell your stock. So let's say sometime in the future you sell your stock for 120 crowns. Only upon the selling of that stock, that could be a few months later, that could be a few years later, only upon the actual sale of that stock do you realize any type of gains. However, when you trade futures, these the profit or loss that you have on each day is not carried forward. It's actually marked to market and settles in your account each given day. So if you buy a futures contract and it goes up by 2 points, the amount that you actually profit by will actually be settled in your account at the end of the day. If the next day the value of the future moves down 3 points, you would actually, that amount would actually be taken out of your account. So that's what we call mark to market. So the amount that you actually profit and you have a profit or loss in your portfolio is actually settled in your account every single day. So you never have to worry about a large unrealized gain or large unrealized loss that you're carrying for days or months. Each day you're settled in terms of cash what your profit and loss is. Now, when we're trading futures, we talk about them in terms of tick size. So each tick on the index is 0.25. That's the minimum size that the futures contract will move by. So if, let's say, the current futures contract is at 1786, the next possible price it can tick up by is 1786 and 0.25. Meaning it can't be 20 or 10. The minimum tick size is 0.25 crowns. And there are 4 ticks to each point in the index. So when we talk about futures trading, we usually talk about them in terms of ticks when we're day trading them. But 4 ticks to a point, 1 point equals to 1 crown. So when you have the index move from 1786 to 1787, that is considered 1 point or 4 ticks. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you, that each point of the index equals to 4 ticks, and the index will only move by a minimum of 1 tick at a time. It won't move at half a tick. It will only move 1 tick at a time, and there are 4 ticks to 1 point. So great, okay. And the futures contracts, because they have expiration dates, they're listed, they have 3-month expiration dates, and they're listed just like futures contracts. They expired on the 3rd Friday of every single month, and they list out at the point right now about 12 months worth of futures in terms of the standard. If you look at the standard contract, they actually list out quite a few years, but they're actually mostly quoted for the first year or so. The new futures contracts are brand new, so they're still only quoting the first month at the moment. We will expect as more liquidity comes into the to the markets that you're going to quotations on later dated options. But when we talk about futures trading, almost all of it will be in terms of the front month options, the front month futures. So whenever we're trading futures, we're always typically trading the front month futures because that's really where most of the liquidity is. Even though there are back month futures that you can trade, generally speaking, for most speculators in the markets, they're only trading the front month expiration, the expiration that's coming up. Now, what you have is a final settlement, and when we talk about final settlement is actually what happens on the actual expiration date of the futures contract. If you're holding the future contract on the last date, the final settlement is the difference between previous day's settlement and the VWAP on the settlement or expiration date. Now, this is more of a technical understanding of how settlement works. I will show you that when you're trading futures, generally speaking, most traders will roll out their futures contracts before expiration. You usually won't hold the futures contract in the last 1, 2, or 3 days prior to expiration, because at that point, that's usually when liquidity will roll off of the front month and liquidity will shift to the next month. It's usually in the last week, about 3 to 4 days before expiration, where those rolls start to happen. And usually that's when new expirations are listed, and the new expirations are listed 4 bank days prior to the expiration of the front month. For those of you that are asking what VWAP is the volume weighted average price on the expiration date. You can look it up if you want to Google it. It's volume weighted average price. It is a simple, I wouldn't say it's a simple calculation, but it's a calculation that many brokerage platforms will help you calculate so that you have a better understanding. But I will say that this is not something that most traders should have to worry about, simply because, again, you shouldn't hold a futures contract to expiration. You should usually roll it well in advance, and usually futures products are day trading products. You usually don't hold them even through the overnight session. So generally speaking, settlements for futures contracts, for the most part, when you're day trading these products, is not something you typically have to worry about. And Wolfgang, yes, you are correct, because these are now a 10 multiplier. Each tick is going to be 2.5 crowns. 1 point will be 10 crowns. In the full futures contract, 1 point is 100 crowns. In the mini futures contract, it is 10 crowns per point in the underlying index, okay? Does that make sense, everyone? Please type 3 into the chat window if the OMXS30 index futures contract makes sense to you. And if this doesn't make sense, it's okay, especially if you're brand new to futures trading. There's a few terminologies that you have to learn with futures trading, just like with options trading. So hopefully today is giving you a quick snapshot of what is the important things to remember. And then when you actually go and actually learn to trade these, when you're actually starting the process of trading these, you can come back to this recording because some of these things will make a little bit more sense, like tick versus points, you know, how much the margin requirement is on these things. These are all things we're going to go over here today, but you might want to learn a little bit more and come back to this recording on some of the relevant information. So like I said, one of the big differences between futures trading and stock trading or options trading is the fact that they're mark to market and they're settled daily. So your profit and loss of your underlying position at the end of the day is settled. So you're not carrying unrealized loss or gain into the very next day. And this eliminates any large profit or loss that may endanger the clearinghouse. So the clearinghouse guarantees the counterparty risk, and they do so by marking to market any gains or losses at the end of each day. So no single party is carrying around a large amount of unrealized gain or loss that they may not be able to cover. And by doing this every single day, it ensures the quality of the clearinghouse. Now, when we're trading on futures, one of the potential benefits of trading futures is the fact that you can trade on a fair amount of leverage compared to equities. Now, leverage is obviously a double-edged sword, so you have to be careful as far as how much leverage or how much effective leverage you're actually deploying on your portfolio. Now, for each futures contracts, generally speaking, there is about a 15% margin requirement of the index value that is required to hold a long or short contract. However, your actual margin requirement that's required may differ depending on which brokerage firm or bank that you trade with. So I'm going to use 15% as an example, but you may actually find that at your brokerage firm, they might charge 20% or 25%. It depends on your broker. So that's something that I can't specify until you speak to who you trade with. But the margin is the amount that you need to put on deposit in order to open a futures contract. So for example, if we're talking about a mini contract here, which as we said was about 17,680 crowns, if the margin requirement from your brokerage firm is 15%, that means that you need 2,652 crowns in margin to control your 17,680 crown contract. So that is the amount that is required for you to hold on to that position. And I'll talk you through kind of the average range of the underlying stock to show you just roughly how much the OMXS30 index moves on average. And that gives you an idea as far as how much risk you actually have on a single day on average for the 2,652 crowns that you're putting up in order to enter this position. Now, at expiration, you have 3 choices as far as what you can do. You can either close your position, which simply means offset the existing position that you have prior to expiration. Like I said, most traders will do this usually about 3 to 4 days before the expiration date. You usually do not wait until the last day, because by the last day, liquidity is already rolled off of the front month and is now trading more on the back month. And this usually happens about 3 to 4 days before expiration. You can roll your position. So if you have an existing contract, let's say you have a long position that's about to expire, but you want to hold on to your long position, what you simply do is you close your front month position and you open up at the next month's or the next expiration's position. This is what we call a roll. This is simply closing out your existing futures contract and opening up a brand new one for the next expiration. Lastly, you can go into settlement, which means hold your contract open through expiration, and it will be settled based on the final settlement calculations. So like I said, for most investors, if you're trading and using these products as whether for speculating or for hedging, rarely will you actually hold them through settlement. You'll usually close it or let it roll to the next month. So those are the general things to be aware of when you're trading futures that is a little different than when you're trading stocks or trading options. The expiration part is similar to options because you have an expiration date. You have to choose something to do. You can hold it through expiration, but rarely do we hold options through expiration. We usually either close it or roll it before expiration. The same thing with your futures contract. Does that make sense? Please type 4 into the chat window if that makes sense to you. Okay, perfect. I see a lot of 4s. So who trades futures contracts? Generally speaking, we have 2 groups of traders that are trading futures contracts. 1, we call speculators. 2, we have hedgers. So generally speaking, I would say the majority of traders in futures fall under the speculators group. This is basically either an individual like you and I, or a firm like a hedge fund or a bank that basically takes on risk to potentially try to make a profit. That's like any other trading that you're currently doing in your portfolio where you're effectively putting some money at risk in hopes to make a profit. Those are predominantly who is trading futures products. They could be individuals, they could be firms doing it on behalf of a client or doing it on behalf of their own book. Regardless, these are individuals or firms that have a directional view on the underlying asset. So if you look at the OMXS30, you either believe the index is going to go higher or you think the index is going to go lower, and you're effectively placing your money at risk to try to place that bet. And if you are correct on your directional view, you can make a potential profit on that trade. On the other side, there are what we call hedgers. These are participants in the market that are not trying to speculate on the directional view of a stock. They're simply trying to protect some existing exposure that they have. Now, if we think about hedgers, some of the more classic example of hedgers are really farmers or someone who has a lot of either some kind of agriculture good or some kind of commodity that they are extracting out of the ground or they are producing, and they want to lock in a price. Those are what we can traditionally call a hedger. So someone who's, let's say, planting corn, and let's say the price of corn right now is, let's say, $4, and they want to make sure that if, let's say, between the time they plant their corn and the time they're able to sell it on the open market, they want to make sure that maybe if the price of corn declines from $4 to $3, they want to protect themselves. They are using futures contracts in order to hedge that risk. What they'll do is they'll short the corn futures contracts. So if in between the time between they plant the corn and the time that they are able to harvest it and deliver it, the price of corn drops, what happens is they will only be able to sell their corn for $3 in the future, but what they would have done is they would have made $1 on the futures contract. So basically what they've done is they've hedged their risk to the downside. So that's what we traditionally call a hedger in the futures market. So these are the 2 primary participants in the futures market of who are using futures contracts. Now, you could also be using hedging strategies for your portfolio. And that's something we're also going to talk about here today, is an example of how you can hedge your stock portfolio using the futures contracts, where you're sort of speculating on a directional view, but your true goal is not to speculate. Your true goal is to protect your portfolio. So we're going to talk through, how you can use futures contracts to protect your portfolio. So this is really an individual firm that's buying or selling a future to hedge their existing exposure. So that exposure could be, a portfolio that you have, or maybe you're a portfolio manager and you want to protect, some downside. You see some volatility coming up, you want to protect it, and what you're going to use is a futures contract to offset the existing exposure in the underlying asset. So in this particular case, we're talking about the OMXS30, but it could be any futures product that you could be trading. You could be using it as a hedging tool. Does that make sense, everyone? Please type 5 into the chat window if speculators and hedgers as the 2 primary participants in this market make sense to you. Okay, perfect. So now let's talk a little bit about day trading futures. So this is where we're going to start talking a little bit about strategy, start talking about the technical side of trading these products as a day trading tool. Now, the reason futures trading is so, I would say, attractive to day traders or very active traders is because of, number one, futures usually has a large amount of liquidity, meaning it's easy to buy and sell these types of futures contracts. You can usually buy a very large amount, sometimes the most liquid financial instruments are these index futures products, and they are very capital efficient in terms of allowing you to take very efficient short and long positions in the underlying market with a small amount of capital. So the margin requirement, like I said, for most of these futures contracts may be in the 15 to 20% range, versus your margin requirement on your stock might be 50%. So if you have a $100,000 stock, 100,000 crown stock position, you might need to post 50,000 crowns in margin in order to trade 100,000 crowns. Here in futures, you can trade with only 15% of that margin. So it's very capital efficient for short-term and day traders here to be able to control a fairly sizable position for a small amount of capital. Now, again, leverage is a double-edged sword. It can work in your favor if you're using it and you get the direction wrong. It could also blow up against you if the trade that you trade is going against you. So you have to be very careful when you're calculating leverage and how much leverage you're actually using in your portfolio. But one of the distinct differences of futures trading is that the margin requirement for long or short positions is exactly the same. So meaning there's no difference whether you want to bet on the index going higher, or if you think the index is going to go lower. When you short a stock, you have to pay margin interest, you have to borrow the stock. There are a lot of costs to shorting a stock. If you're buying a put options, generally speaking, are a little bit more expensive than call options. So there's always a difference in terms of buying or shorting an underlying stock or an option. But when you're trading futures, they are equally the same. And again, that's part of why many day traders really like this type of product, because they get to have true symmetrical exposure to bullish or bearish, where their margin requirement is the same for both long and short positions. So most day traders will typically use very short-term charts. So when I was trading options, we were using minute-based charts, anywhere from 1 to 5 minute charts. What that means is that each candlestick, each bar on the chart that you're looking at represents somewhere between a 1 to 5 minute range. And what we predominantly use was momentum indicators. So we can use any momentum indicator that you prefer, whether it's RSI or stochastics or MACD or CCI. I, at the time, predominantly was using CCI, or what we call commodity channel index. But all of the indicators predominantly are all measuring the same thing. They're just slightly different variations of the same measurement. And there were predominantly 3 things as a futures day trader that you needed to learn to be proficient at in order to trade futures. Number 1 was reading price action. This was basically just understanding basic support or resistance levels and understanding how they worked and when a stock breaks out of a support level. So for example, if you have a support level and the stock breaks below it, or if you have a resistance level and the stock breaks above that resistance level, understanding when the trend is sideways, when the trend is starting to turn up, or when the trend is starting to turn down. That was the first thing that you needed to learn as a futures trader, is just basic price action, what's currently going on with the underlying stock. Then what you needed to learn was momentum buy and sell signals. So all of these momentum indicators that I referred to, RSI, stochastics, MACD, CCI, if any of you use any of these indicators, type in which one you prefer to use on the chat window if any of you use any of these momentum indicators. And what you need to learn is when they trigger a buy or sell signal. So most of these indicators have very clear thresholds as to when they trigger a buy or a sell signal. You just have to learn those triggers in order to utilize them. And lastly, in my opinion, one of the important parts of learning how to trade futures is learning to read divergence between momentum and price, because that many times can give you a signal as to the trend that you're currently watching is potentially coming to an end. So we use support or resistance levels to give us our primary trend. We use momentum to confirm those and give us a buy and sell signal. And lastly, we look at divergence to potentially signal that the trend has ended. And I'll walk you through my actual strategy as to how I would use these technical indicators together to generate actually buy and sell signals, and when I would consider it's time to get out of a specific trade. So these are the primary tools, or these are the basic tools that a futures trader would utilize in their trading for futures. So I know many of you have just typed in RSI, stochastics, MACD, And so a lot of these similar indicators that you're using. So I'll walk you a little bit through my technical strategy. Number one, what I use is basically three things. I use a long-term momentum, so a momentum indicator. So for example, for many of you answered RSI. What I typically have is two RSIs on my chart. I would have a long-term RSI where I would use maybe somewhere between a 30 to 50 period. I was actually predominantly using a 50 period CCI at the time to give me a determination of the longer term trend. So when you use a longer time period, that gives you a lot less noise of the short-term movements. You get to be able to see the long-term momentum. And then I would use a very short term as my trigger, usually 5 to 9 periods. I was using the 5 period trigger to generate the actual buy and sell signal. So what I was looking for is a strong trend in one direction. And then what I was looking for is a small counter trend, and using that as a signal that this was likely going to continue in that direction. And I'll walk you through some examples here with an actual chart here. And lastly, what I was doing is I was using momentum to give me a sense for when this trend was going to end and start reversing lower. And that's where I was using divergence between the chart and the momentum indicator to give me a sense that the longer term trend that I was looking at was about to come to an end. Okay, so that's predominantly what the core strategy is. And I'll walk you through an actual chart to show you how I set up my trading day. So here's an example of the OMXS30 index. This was a fairly recent 1 minute chart. So each bar on this chart represents 1 minute. And what I have is I use typically almost no indicators on the chart itself, because I think the most important thing is to learn how to read the chart itself first before anything else. You don't want to have too many indicators because that sometimes can confuse you. Use the chart itself as your primary indicator. And then what you use is this down here is a 50 period CCI, and down here is a 5 period CCI. So it's the same indicator, but one is using 50 periods to calculate that momentum, and one is using a 5 period to calculate that momentum. So you have one long-term trend and one very short-term, what we call fast trigger for the underlying stock, or underlying index. So one of the things that you might do is, we always read the chart from left to right, is always look at price action first. So if we look at this, initially what you have here is a bit of an established trading range where once it breaks below that support, then you can start taking a look at potential shorts here. Notice how this didn't last very long and it's still stuck within this trading range. So for a long time, what this means for me is that there was no trades to make here. There really wasn't any trades to make until this started to break below this support level, came back to test this as resistance, and started to move lower here. So for me, just from price action alone, this is telling me that this index is starting to potentially start a bearish trend. Once I have that price action view, what I then is I look at my 50 period CCI indicator. As you can see, there's a 0 line here. If it's above the 0 line, that's a bullish trend. If it's below the 0 line, that's a bearish trend. So what I have here is that as the index started to move below that support level and starting to come back to test this as resistance and moving lower, look at my momentum indicators. They were fairly negative. So as long as these momentum indicators were negative, that was my confirmation that this is now in a bearish state. Once something is in a bearish state, all I need to wait for is the short-term trigger to give me the sell signal. So if you are a CCI trader, and every momentum indicator is a little different, but they all work the same way. You have a buy signal and a sell signal. When the stock gets above this level, that's a sell signal. So that would be my first sell signal. And then as long as the trend stays the same, I would continue to wait for these fast triggers to give me sell signals. Each time I got one of these spikes in the short-term indicator, that would be a signal to sell. So I'd have a sell signal here, a sell signal roughly here, a sell signal roughly here, and here. Now, how do I know when these sell signals are no longer valid? That's really where I turn to momentum divergence, because as you can see on this last push lower, the price action went lower, but momentum did not confirm that move lower. So we have what we call a divergence. This is a negative divergence where price makes a lower low, but momentum does not make a lower low. Once I see that, that is cut off from the bearish trend. We are no longer in a bearish trend, and we are no longer taking any trades. So only in this whole chart, there were only very few valid trades, 1, 2, 3, and 4. Once I get that negative momentum, negative divergence, that is cut off from the strategy, and that is the end of that specific opportunity. And what you do is you might wait and you might say, okay, things have now reversed higher here. This might be the start of a bullish trend. Once you get the bullish trend turning positive again, now we can potentially say, okay, now we've entered a bullish trend. Now let's look for some buy opportunities here. So same thing, now that the momentum has now shifted to more of a bullish view, now what we're looking for are buy opportunities. So what I want to do is I want to look for, here's one buy opportunity, here's potentially two buy opportunities, here's potentially a third buy opportunity. And at some point, as you can see here, we start to see some negative divergence. As you can see here, I'm making a higher high, but momentum is actually flat here. This is telling me that, yes, I can potentially take this, I can take that last one, but on that last one after that, it is no longer valid. This is telling me that this bullish trend is starting to come to an end. So that's how I know that I have these 4 valid signals, and that's it. And this bullish trend is no longer starting again. Now, the only time that I would restart that bullish phase again is once the fact that we've now broken back above this resistance level. Now I'm back in a bullish trend, and maybe at this point I might consider starting to buy again. But that is the core strategy here. You have to be very patient. You have to wait for a trend to start to develop. You use the momentum indicator, the long-term momentum indicator, to confirm your bearish or bullish view. So you first take price action, wait for the start of a bearish, break below support. That starts of a bearish view. You wait for your directional long-term indicator to confirm that. Once you have a confirmed bullish or bearish view, then you wait for these triggers to actually generate your buy and sell signals. And you continue to trade those buy and sell signals until you start to see that the momentum that you were, the trend that you were experiencing has started to see some divergence. And that's telling you that this trend is likely coming to an end. So that is at the core, a basic futures trading strategy. There are many, many variations of this strategy. You can, if any of you try to look up on Google, futures trading strategies, many strategies are adapted from the same type of methodology, which is trying to determine a long-term trend, and what you're determining is short-term pullbacks in that trend as opportunities to buy that asset. Most futures trading strategies all stem from this one core idea. Now, different traders will use different indicators. Some will use RSI, some will use momentum, some will use proprietary indicators. I tend to find that I like CCI when I was trading it, but you can really use any of these indicators, in my opinion, to use for the similar type strategy. Now, just to give you an understanding here, if you look at the OMXS30 over the last 5 years, the average daily range, meaning the average high to low of that range, is usually somewhere in the 12 to 14 point range, which means that when we have 4 ticks to 1 point, that's roughly 48 to 56 ticks per day in terms of a range that the futures will trade in. What that means is that if you're trading a single standard futures contract, you have approximately 1,300 crowns of exposure, if you happen to buy at the low and sell at the high. So that just gives you a sense for the size of exposure you have. And remember, on a mini futures contract, you're roughly putting up about 2,600 crowns in margin requirement. So 52 ticks times 2.5 crowns per tick is an exposure of about 130 crowns. So roughly 5% of the margin requirement that you're putting up is, on average, the type of exposure that you'll see on each given day. Roughly 5% of the margin requirement that you're putting on in terms of exposure. Now, as far as the trading strategy that I just taught you, and again, I don't expect everyone to remember this from the very first time. You might learn a little bit more about futures contracts and come back to this, but I will say, the hardest thing about trading futures is, number one, setting rules. Setting the rules up for trading futures, and I'll talk to you through some of my rules for it, having patience, and more importantly, having discipline. What I just showed you before is a chart where there were plenty of opportunities on a single trading day. It looked like there was about somewhere between 8 to 10 opportunities to buy or sell during that trading day. I will show you on the next chart where you could have a whole day where there's only maybe 1 or 2 opportunities. And that actually, in my opinion, is by far the hardest days to trade, to stay disciplined and to stay patient and wait for the right setup. So when I traded futures, doesn't matter whether I took a long or short position on that futures contract, I would always place a take profit and a stop loss order upon the entry of the trade. Meaning the second I entered the trade, I immediately already knew when I was going to get out, either at a profit or at a loss. There was no changes to that. Once you place those orders, my platform actually allowed me to automatically place a top take profit and stop loss order. Depends on which brokerage platform you trade with and what type of order types they support. But I was able to put what they call an OCO bracket order. So one cancels the other. And once I entered the trade, it automatically placed my stop loss and my take profit orders all at once. So this way, once I enter the trade, I don't have to do anything. It automatically exits my trade once it either hit the take profit or stop loss. Those are the rules-based approach that you absolutely need to take if you want to become a successful day trader in these types of products. I was using something along the lines of having 8 ticks or about 2 points for my take profit, and I would use about 7 ticks or for my stop loss, about 1.75 points. So what that meant is that even if I was just 50-50 at betting when the markets are going to go higher or lower, long term, I was going to be making a 1 tick profit for every 10 trades that I was making. So this is really where if you were able to be right 60% of the time or 65% of the time on the directional view of a trade, that's how you can make a profit long-term day trading these types of products. But the one rule that I always had whenever I'm trading futures is that I must close out all positions before the end of each trading day. I never held the futures contracts through the overnight session because many times you might see that you might, the market might close at a specific price and then gap up or gap down at a completely different price the next day. You don't want that type of exposure as a futures trader because this is meant as a short-term futures day trading product. You can't really translate what the day trading 1-minute bars into where the market's going to open tomorrow. It could be a news driven event. It could be a geopolitical. That's not what these futures products are for. So generally speaking, as a day trader, you don't want to hold these products overnight. So just to give you a quick example here, if let's say I got a bullish signal to trigger that buy signal when the index was at 1780.5 crowns, let's say I bought 3 mini futures contracts. So I bought 3 mini futures contracts at the price when the buy signal was triggered on the strategy I just showed you here. My margin requirement here, this is the margin requirement for a single contract. You would have to multiply this by 3 to give you the margin requirement for 3 mini contracts. And let's say I bought it when it was at 1780.5. And let's say once I bought the 3 contracts, the value of the index rises 2 points to 1782.5. So rose 2 points. To calculate my potential profit or my profit on the trade, what I do is I take the 2 points, which is the 1782, what I sold it for, minus the 1780.5, what I bought it for, which is 8 ticks, 2 points, which is 8 ticks, multiply that by the 2.5 crowns per tick, multiplied by the 3 contracts that I purchased, gives me a 60 crown profit on the actual trade. So that just walks you through a brief example of if you bought something at 1780.5, sold it at 1782.5, and you traded 3 contracts, how would you calculate your P&L on the trade? So if you held on to this trade and at the end of the day, this is what you would profit on that one trade. So as you saw before, I was showing you where I found about 7 to 8 trades in a row. If all 7 to 8 trades in a row were profitable, I would be looking at 60 multiplied by, let's say, 7 would be my total profit for the day. Now, in the trades that I sent you, it didn't seem like any of the trades was stopped out here, but very possible you will have trades that stop out. So I want to show you some examples of, a different type of trading day. So before I showed you what I consider an ideal trading day for futures, but what I'm showing you now is a much less ideal trading day. And these, in my opinion, is probably the hardest to trade, because what you never really establish is a true directional trend. And what you get is a lot of chop. And the hardest thing, I think, for most traders is to sit there patiently waiting for the right setup and potentially not only getting one or two in a whole trading day. That probably, I would say, was the most difficult part about futures trading, because to trade futures or day trade, you have to sit in front of a screen. You can't go get coffee and come back and look at the screen for a few seconds and see if there's a trade. You have to be in front of your screen. So this is not something that's necessarily suitable for everyone, at least for day trading these types of products. But sometimes you could be sitting in front of your screen, almost triggering a trade, but not quite getting there. So here's an example of this, right? Where, we started to see this index break above a support level. So you start to confirm that this is a bullish move. You look at the long-term momentum indicator and it confirms that bullish move. But as soon as you get out of the gate, you have a higher high in price and momentum makes a lower high. So that kind of immediately tells me that this trend is not very strong. It's not very, it may not necessarily go. So when you get that pullback and it starts to move again, you get another confirmation that maybe this trend is starting to start again. But again, you continue to get more divergence. So this is, again, to stay disciplined, you don't want to place these trades. If you did end up placing these trades, were they profitable? Yes, they actually were, but that's not being disciplined in your trading. Just being disciplined is having set rules and only trading the rules that you set out for yourself. And then what you see is that, then the trend starts to deteriorate and starts to move lower again and starts to move up again, but it kind of yo-yos between going above resistance or support. Here, it looks like it's about to break a resistance, but it doesn't, and it just fails. And this is really, I would say, probably the most frustrating part about trading futures sometimes, is just on some days, it just doesn't work out. Here, what looks like the start of another bullish trend here, but you make a higher high and momentum doesn't confirm that. You make another higher high and momentum does not confirm that. You make another higher high and momentum does not confirm that. So these are all not what I would consider not a very strong bullish move here. And then eventually you get kind of this move here where you could potentially get one signal, one valid signal here. But then as you can see, it moves a little bit and starts to move lower. So maybe on this whole trading day, maybe you only pulled one or two trades and they both lost. But keep in mind that, for each trade, 7 ticks is about 17.5 crowns. So you lose about 17.5 crowns per contract on each trade. So you might end up losing, end the whole day with just 2 losing trades and no real winners at all. That is the patience that is required to day trade. That is the discipline that's required to day trade these types of products. And that, from my perspective, if you want to learn how to trade futures, is the hardest part to learn, is to sit there on the sidelines, being patient and having your rules and sticking to your rules. Many times I see it over and over again is futures traders is, they get antsy. They sit there and they're like, I want to place a trade. Yesterday I placed 8 trades. Today I'm only trading, I only placed 1 trade. Let me bend the rules a little. Let me trade something even though it doesn't quite fit my criteria. Let me just try to do it. And they end up placing bad trades. Or sometimes, you have a trade that sort of works in your favor. It doesn't quite trigger your take profit and starts to reverse. And you think to yourself, I think it's still positive. I think it can get back and trigger my limit order. Let me move my stops a little so I don't get stopped out, so I still have the opportunity of the stock going, of the index moving higher. Those are all rules that, I can speak from personal experience that I have done that have caused me to lose money in these types of products. A rules-based approach and discipline and patience is by far, the most important thing to learn how to trade futures. So lastly, what I want to leave you with is a hedging example. This is for those of you that perhaps have no interest in day trading. You're maybe more interested in futures as a tool to help you hedge your downside exposure. Some of you have learned that you can use options to hedge your downside exposure. But from my perspective, as a strategist, when I'm talking about, to especially retail clients about how to hedge your portfolio, I tend to find futures products are far better, far more efficient at helping you hedge your portfolio exposure than buying a put option. Simply because put options are expensive, you need to get the timing very, very accurately in order for put options to work. If you are late on it, or if you're paying too much on that put option, your hedge can be very, very inefficient. Or if it takes too long for the for the index to move lower, your put option, you might end up paying too much in time decay. Futures products, in my opinion, are far better at potentially hedging your downside exposure on a portfolio where you want to remain invested, but you want to hedge your downside exposure. So here I have a daily chart of the OMXS30. And what I have here is the coronavirus sell-off. This is what we got from late February to late March, this sell-off. So if you, let's say on this particular day, when this is still using the 50-period CCI. So I use the long period momentum indicator to help me scan for long-term trends that are changed in the markets. This tells me that this was, I believe, February 21st or February 22nd, just a few days after the peak here of February 19th, when the momentum indicator turned negative. That could have been a signal that the market was starting to roll over, that it's probably time or a time that I might consider putting on a put. I'm sorry, putting on a hedge for my portfolio. At the time, the index was trading at around 1800. This line represents 1800. That was the closing price on February 21st or 22nd. And then what I did is I looked at, when did the momentum start to turn around? When did the momentum start to no longer confirm further moves lower? And that was here around April, early April here, and when the index here was around 1445. So let's say I put on a futures hedge where I shorted the market here at 1800, and I didn't close out my position until a few days after that bounce at 1445. I want to show you how a portfolio hedge here would look if you have a stock portfolio that you're looking to hedge. So number one, futures, again, provides a very capital efficient hedging tool. And it's suitable for any portfolio that generally has a high correlation to the OMXS30. So if you have a broad-based Swedish equities portfolio, you could potentially use the OMXS30 as your hedging tool. So depending on the size of your portfolio, you would use either the standard futures contract, or if you have a small portfolio, you might want to use these new mini futures contracts that you may not be able to use prior to today, prior to this week when the mini futures were launched. So let's say you have a million crown portfolio, and let's say you wanted to hedge half of your equity exposure. Let's say you have half of your account in equities and you want to hedge that half exposure. So that's roughly 500,000 crowns in equities that you have. We know that each standard futures contract is about 178,000 crowns. So roughly 500,000 crowns divided by 178 would give you roughly 3 standard futures contracts. So if the market declined from 1800 to 1455, that's a total of 355 points. Now we said that the full futures contracts is 25 crowns per tick or 100 crowns per point. So 355 points multiplied by 100 crowns per point multiplied by the 3 contracts that you shorted would give you a 106,500 crown profit on your futures hedge. So that would offset any losses that you have in your portfolio when the market declined from 1800 down to 1455. So you chose to hedge half your exposure. This would give you exposure to the actual downside move for the 500,000 equity portion of your portfolio. Now, let's say you had a smaller portfolio. Let's say you only had a 100,000 crown portfolio. And again, you want to hedge half of your exposure. Now, half of your 100,000 crown portfolio is only 50,000 crowns. Originally, when the futures contract was at 178,000, that's not a suitable contract because you're hedging, 3 times, a little over 3 times the actual value of your portfolio. That doesn't make a lot of sense. Here, you can hedge using a 17,000 crown portfolio. So now you only need to trade 3 mini contracts. So when the market declined from 1800 down to 1455, that's a 355 point move. The mini futures is only 10 crowns a point multiplied by the 3 contracts gives you the 10,650 crown profit. So you've hedged 10,000, whatever losses that you have in your portfolio, you would make back 10,000 crowns on the hedge that you put on. Now, the reason that I say that the futures contract is a very capital efficient way to hedge your portfolio is because when you're trading futures, there's no time decay. When you buy a put option, you have to account for time decay in how long it takes for the market to decline. Granted, market declines typically happen relatively fast, so you're usually not holding on to a put option for months at a time and paying that time decay. But even if it takes a month, that's still a whole month of time decay that you have to pay for that put option. When you're trading futures, you don't have to worry about that time decay. The margin requirement is the only thing that you need to initiate that futures contract. So here, to trade 3 contracts of this, you need about 7,500 crowns to initiate this futures contract to hedge your 50,000 crown portfolio. Now, the one downside that you have with futures contracts is the fact that if you get the direction wrong, the difference between a put option and a futures contract is the fact that if you get the direction wrong and the market rallies instead, let's say it goes from 1,800 to 2,000, the put option, whatever you pay for that put option, the most you can lose is the value you put on, the value is the cost of that put option. But with a futures contract, when you short a futures contract, there's no limit to how much money you can lose. The further the index goes up, the more you lose on that futures contract. So, but it should be hedged with your portfolio. But what you have is a truly hedged position on both sides. So if the market moves down, you make money. But if the market goes up, you actually lose money. But that money that you lose is technically hedged with the gains that you have in your underlying stock portfolio. So it is a little different hedging. It is only useful if you are fairly confident that the markets are going to decline. So when you have some kind of risk catalyst like the coronavirus, where you're fairly confident that the acceleration to the downside is going to continue, that's when you want to potentially use a futures contract for hedging. So with that, that covers what I wanted to share with you here today. I hope that you guys find this useful in helping you, number one, give you a better understanding as to what futures are, how you can use it for your trading, but also, this hopefully gives you some idea as far as how a futures trader like myself would actually go about using a technical strategy to gain directional views of the market, what rules I had to enter the market, what rules I had to exit the market, what type of discipline and patience that is required to day trade these successfully. So I hope that you find this useful. At this point, what I'll do is I'll open this up for Q&A if anyone has any questions regarding the futures contracts here for the OMXS30. So Henrik saying, what are the fees behind trading with futures and mini futures? So typically, and you would have to contact your broker for all the fees here, but typically there is a commission and a per contract charge to trade futures contracts. You would have to speak to your brokerage firm as to what their costs are for your brokerage firm. But like I said, generally speaking, the cost to trade futures is relatively low compared to some other products. But it depends on your brokerage firm, so I would contact them to ask them how they charge for commissions and fees for trading futures contracts. Wolfgang is saying, what length has the moving average line do you use? This one on this particular chart is a 200 period moving average. So because it's a minute-based chart, that's a 200-minute moving average. But I'll be honest, I should have removed that here because it really doesn't factor into my views here because and if I'm going to use any type of moving average for day trading this, I would use something shorter, like a 20, 25 period moving average for day trading. Are similar products available on all Nordic markets? If you're referring to the other, what do you call it? The futures products, I'm sorry, the other Nordic indices like the Copenhagen 25 or the Helsinki, that's a great question. I know Tomas here is on the phone. I don't know if Tomas has the answer to that question. I can probably find out pretty quickly. So let's see. Yes, there are Copenhagen 25 futures. There are Oslo 20 futures, and there are Stockholm S30 futures. Those are the three that you can trade. So Copenhagen 25, Oslo 20, and Stockholm 30 are the three futures products that are available for Nordic markets. Any other questions about trading futures contracts or any of the technical strategies or indicators? Wolfgang, you're very welcome. Any other questions? You're also very welcome. Shivaram, sorry if I mispronounce your name. Again, for those of you that like trading, especially for those of you that are active traders, whether you're active trading stocks, options, futures products is a great product for active trading, especially if you're looking to day trade. Just because of the liquidity, it requires a small amount of capital to trade a fairly sizable position. And they're very efficient, meaning the fees or the cost to go long or short is exactly the same. So you really have true equal opportunity, regardless of whether the markets are up on that day or down on that day. And when you use a minute-based chart, there are very specific rules that you can build to trade these products. And like I said, there are some days where you can put on, I remember when I was trading futures, there were some days where I was putting on 15, 20 trades in a single day within a couple of hours, within maybe a 2-hour period. And then there were other days where I was only placing 1 or 2. That's again, the variability of trading futures is waiting for the right setup. Patrick is saying, how important do you think are the data feeds and how fast it delivers the data regarding the instruments? I guess some traders gets it faster. So I would say that when you're talking about manually trading, even the slowest feeds are fast enough for that, because, the OMXS30 is not as, high frequency as some of the US based markets. I would say that it's more regarding, your brokerage order management. How quickly can you enter an order into your broker's screen is probably more important than the speed of your data feed, right? Because you might have a trade, but if it takes you 10 seconds to enter that trade, the markets can move in those 10 seconds. So it's really about how fast can you place an order once you've determined an actual entry point. I think that is actually what slows most traders down more than anything. I used to trade on what we call an active trader platform, where it was a single click. I already had predetermined rules of, once it was 1 click buy, 1 click sell. Once I enter that buy order, it automatically placed my stop loss and take profit orders. So that was how I was trading futures. I do think that for those of you that really are serious about day trading, think about investing in some of the technology that allows you to do that sometimes your average brokerage platform may not be able to provide that, or some brokerage firms provide active trading tools that allow you to place these orders very quickly. Those are some of the things that you might consider investing in, but I don't think data feeds is usually the part that slows you down. Are there any automated trading platforms? Not that I'm aware of. For those of you that trade with Interactive Brokers, that is an international broker that I know that does have some tools that allow you to, if you're capable of writing your own code, to allow you to automate your trading platform, but your trading. However, I will say that not a lot of futures traders are automated trading platform or automated trading strategies. They usually involve some amount of manual intervention from a human being, in my opinion. Any other questions? So Patrick, at this point, we're not offering futures trading in the OptionsPlay platform yet. This is something that we are looking at adding. However, at the moment, we are only an options trading technology shop. But again, because I had a futures trading background, that's why I wanted to teach you guys a little bit about this new product. We do have a strong partnership with NASDAQ, and this is a NASDAQ listed product. So I did want to get on, let you guys know that there's this new mini product that is more suitable for retail, especially if you're an active trader, and share with you some of the rules and some of the challenges that I've faced when I was trading futures to hopefully help you understand a little bit of those before you start trading, because those are some of the things that took a long time for me to learn, trading these things. So hopefully I was able to embark some education and some knowledge as far as how to go about trading it, what are the challenges of trading it, and what are the rules that I use to successfully trade these futures products. Patrick, you're very welcome. Any other questions before I sign off here for today? If there are no other questions, I just want to thank everyone for taking the time out of your evening. Bo is saying, why don't you trade futures anymore? Great question, Bo. I stopped trading futures because trading futures was something that required me to sit in front of a screen for about 2.5, 3 hours a day. And during those 2.5, 3 hours a day, I really couldn't do anything else other than trade. So if you're the type of person who has that time and the ability to do that, certainly, more power to you. But I have a business to run. I have a company to run. I simply can't take 3 hours of my trading day and just sit there and trade futures. I love what I do. I love teaching options. I love running my business. So that's what I've chosen to do with my career rather than trade full time. So with that, again, thank you so much for taking the time out here this evening. I hope that you guys learned something. I hope that you guys found a new product that perhaps you might be interested in trading. I will send out the recording with the slides so that you can watch this at your own pace, because like I said, once you go through the learning process and you start doing maybe some paper trading or start trading on your own, you might want to come back here and revisit, the strategy itself, some of the rules that I have in place. Those are the things that I used to have in place for all of my futures trading. So I hope that you're able to take that into your own trading as well. So thank you so much. Have a great evening, and I'll see you guys here next week on our next options education event.